Good afternoon. John Liston with Alberta Enterprise Group here. It's Thursday, it's noon, and we're going to have some fun today talking a little bit about capital raising. Danielle Smith normally does the show. She is in Calgary at the Energy Executives Business Forum, and so I am filling in. And speaking of filling in, I'm going to introduce you to our guest, Phil Duhome.
Starting with a dad pun right off the bat. Well done, John.
Phil is a practicing lawyer who has come into the practice of law at the same time as a series of regulations came into Alberta, and has become what I have experienced as one of the experts in understanding kind of the three pieces of the triangle: the investor, the company that the investor's putting money into, and then the regulatory environment in which that is guided. And so that's what we're going to talk about today: is those three parts, the different roles that they play, and the partnership that they play. I think very often the regulator is seen as a boogeyman, and what we need to understand is the significant role that they do play in guiding the capital markets to work properly. So welcome, Phil. Great to have you, and really looking forward to the next hour talking to you a little bit about some of those things.
Thanks, John. I'm excited to be here. As much as I never like having to do these things, I'm always happy to chat with you. And sorry, my phone just rang. That was very unprofessional right out of the gates.
No problem at all. Listen, let's go back a little bit, Phil. You're from Alberta. You went to law school here?
I'm Edmonton born and raised, and I just stuck through for university all the way through in Edmonton. This is where my roots are, and I'm kind of like the family being here and all the friends, so I never went anywhere else.
So you graduated from law school what year?
Well, I was promised there would be no math. I graduated in 2008, I want to say.
Which is a very interesting time in the capital markets in Alberta, because for a period of time, it was a bit of a Wild West. Companies could go out and raise capital without really any formal offerings, prospectus or offering memorandum. And as 2008 was coming along, there was a lot of when things went well, everybody loved it, and when things didn't go well, everybody blamed, why wasn't the regulator there to protect me? So can you talk a little bit about that pre-2010 period?
Yeah, it was a really interesting time. To do it justice, you kind of have to focus on the fact that there's two core subsets of the securities regulation. One is sort of that question: can I raise money by selling my securities, my investments to somebody? Can I do it? And then the second one is, am I allowed to make selling part of my business? And so for the longest time, there's always these two pathways. Now, everyone's familiar with the concept of an IPO, right? You go public. And that's sometimes the dream for companies, is that one day they go public, their securities are traded on an exchange and people buy and sell them, and that's what they do. In order to do that, a lot of companies do an initial public offering, which is a distribution to the public at large using something called a prospectus. It's a giant disclosure document that theoretically tells all of the investors what they need to know about the risk, the company, its structure, to make a sound decision to buy or not buy those investments. And that's sort of the gold standard from a disclosure standpoint. And that's why the regulators typically say anyone's allowed to buy under that regime. The disclosure and information is out there. That transparency creates a safe environment for a market. Unfortunately, or fortunately, I guess, depending on where you sit here, not every company can go public. They can't afford it. There's a lot of cost that is associated with that. Not just the act of going public, but even after the fact, there's a lot of continuous disclosure and reporting and things that you do. That's why when you look at the exchange, you'll see big companies, not, your neighborhood corner restaurant or whatever you find. But that isn't the only way to raise money, by selling securities of your own, or investment of your company. The other option is to do a private distribution. And a private distribution is often referred to as a prospectus exempt distribution. So we're going straight into all the ridiculous terminology. And that concept has existed for a very long time. It's generally couched around the idea that if you are selling investments to people that are very wealthy, they can bear the risk. People that are very sophisticated, they're deemed smart enough to consider the risk, or certain sort of lesser disclosure types than a prospectus. Now that environment existed in 2008, 2009. But what used to be in place was if you were going to use a prospectus exemption. So if I was a company and I was going out to, a wealthy group of people that I maybe had encountered and said, look, invest in my company. The act of me doing that was simultaneously an exemption from the need to create that big old prospectus document and all the disclosure, and also an exemption from having to register with the securities regulator to tell them, I'm in the business of raising money, and this is what I do. And what they changed was they said, okay, that was too dangerous, because what had evolved out of that was groups that weren't really true private businesses anymore. It wasn't your corner store restaurant or your startup business that was going out and just raising money for their own enterprise. There were people, entrepreneurs and innovative, rightly so, that said, hey, I know, I'm just going to be in the business of raising money for the people that need it. And they would go out and they would earn commissions and so on and so forth doing that. And sometimes, because they weren't heavily regulated, they were loose with the truth or aggressive in their sales, or put those securities into the hands of people that shouldn't be bearing private company risk. So 2009, really it's more like 2010 when it officially kicked in, the regulators said, okay, stop the presses. If you're going to sell private securities and that's a business, we want you to register. And that gave rise to this exempt market dealer industry that people hear about sometimes. So it's a very complicated answer right out of the gates.
No, it's a great answer in that it's think of running a business, and that's who's watching and listening to us today is a group of people who are business people. Their primary focus is on the doing of their business.
Yeah.
But they have to raise capital to be able to do it. If we want to buy a new building, and do I go to the bank? Do I go to the private market? And so they're always involved in both of those roles. So it's interesting that the regulator wants to separate them, but by the very nature, that business person is in both. Am I wrong there?
No, you're absolutely right. I mean, I do want to give the regulators some credit. And it's a very difficult concept is, are you in the business? And that's what they decide. You separate it because if your business is capital raising, then you probably need to go through all the hurdles and you owe certain duties of care to the investors you speak to. If your business is not capital raising, your business is the restaurant or your business is the pipes or, the manufacturing, you can still raise money for yourself. There's no direct prohibition on that. It does turn into a gray area very fast, which is what you're alluding to, because you're like, okay, I've got to raise a bunch of money. Why don't I hire some salespeople to come and work for me and pay them based on their success as capital raisers? Now we sort of go, okay, well, which hat are you wearing? Which pathway in the regulation are you going down?
Yeah, it's interesting. And again, we titled this Capitalism for Small Business. And so, what would you define as? Every business is a big business as long as it's got more than one person in it, because it's complex very quickly. But what does the marketplace define as kind of small, medium enterprises? This SME term.
Yeah, and I do want to just pull back for a quick second. So anyone who is still patiently bared with us through the last little bit, we'll probably talk all about businesses raising money for themselves and how they do it. We'll talk a little less about the registration side. So don't let what we just talked about dissuade you from wanting to pursue this. There are avenues available. But, you ask about what is a small business, and what's fascinating is it depends on who you ask that question to. And that's sort of the root of why it's so difficult for small businesses. People that are watching this might be saying, I struggle mightily to capitalize my business other than going to the bank that will only lend to me if I don't need it. And the thing is that's because the regime says, from some perspectives, like the regulators, they think of small businesses sometimes as anything less than $50 million. That term is sometimes thrown around as being nano cap. So you'll hear large cap stocks, small cap stocks, nano cap is like less than 50. But I mean, you go to our exchanges, we have a ton of nano cap on our exchange because we're not the state. For me, when you ask that question, what is a small business? I think it's anyone who is raising less than $5 million is a small business.
Okay, and I think it's good to kind of lay that one out, because there's this, back to the going public. You talked earlier about going public. Can you talk at all about the costs up front of going public? Is it $10 million? Is it $1 million? What does it cost to go public? Is that an unfair question?
You're making me give all the typical lawyery answers. The everything starts with it depends, but um, I would say that for most, large sophisticated businesses, often going public comes with a transaction around it as well. You're flirting with $1 million in legal and accounting fees.
Yeah.
To get there. So it can be done much cheaper. There's some very innovative groups out there, and we're in such an interesting time period economically that everyone is trying to solve these sorts of, foul cost barriers that exist. So there are other ways to go public. Reverse takeovers sometimes can be easier. You're hearing about SPACs and other groups that are doing this. So there's other paths forward. There's also exchanges that are catered specifically to smaller businesses. You'll look at the CSE and NEO and all those groups coming in. So it can be done for cheaper. But generally speaking, if you are, some people would say 50 million or less, but if you're 10 million or less, I would strongly discourage considering that unless it's purely being done for liquidity purposes.
Yeah. And again, that's one of the ways that you do have an exit strategy is possibly going public and letting someone else take on the risks and rewards. Or distributing it amongst investors.
Yeah.
So let's kind of go down the road a little bit. 2010, the government comes in with a set of regulations. Do you want to talk about NI 31103? I hate to start throwing those numbers around.
Yeah, well, I can. Yeah, I'll start citing instrument numbers, and we can lose every viewer at once. We can, but maybe John, the pathway to talk about this is to almost follow the route that is taken by a small business. This is one of the things that sometimes I get a little bit angry about is everybody in the financial services industry, sort of gets to the ivory tower and looks down from their own position. So it sort of always starts at that idea of, public companies and IPOs and dealing with registrants, IROC dealers and EMDs, or are we a mutual fund, and all this really complex stuff. And I think that the disservice we do to the public at large with that is we make that very intimidating for those that are supposed to elevate themselves to that level at a later point in time. And I say this a lot when I'm having these types of engagements with people where we're speaking is, all of those great big companies that you hear about and the ones that get to be listed in the newspaper and so on and so forth, they all started out small. And we like to romanticize the fact that these companies begin in a garage when we talk about them after the fact. But we never sit around and talk about the company that's in the garage today and how we help them get there. So what I'd almost rather do is talk about, okay, well, what if you do have that startup? What does that pathway look like from the day that you're that person with an idea, you're trying to innovate in Alberta and do something brand new? How do we help you capitalize yourself up slowly as you climb that step ladder to the point that you do your public offering, you become a public company, and then you become the success story? That's
I love it. I love it. That's exactly, I think, what our viewers would like to hear.
Yeah.
So go.
Cool. So now I just get handed the mic and I have to talk for 45 minutes. So I guess the thing that begins is, no business, or at least very few, start up and say, I want to raise money. How do I come up with an idea that helps me raise money? It goes in the opposite direction, right? You create your idea, you build up your business idea, you have all of your modeling, et cetera, and you say, okay, I can't do this without money. And there's any number of options early on. And I would say that for startup entrepreneurs or active businesses, the very first place you look should never be selling shares of your company. It's the wrong starting point. The first thing you should always look at is how much you can do with sweat equity and work on your own to accomplish your objectives. And also look for government grants and other relief that is out there that is supposed to foster this group of the economy and get them moving, because that money is typically cheaper and safer than giving away what your company is. And you will have less of a battle in trying to figure out valuations and all the other things that come with it. Selling investments of your own company can become an inevitability. You may have no choice but to do that at some point. But the warning I have always is it is a lot of work, even if you're hiring professionals to do that and help you. There's a lot that goes into that from investor relations. So I'm sort of starting it off by saying, try your best not to do this until you have to. And you probably will have to, but do your business the right thing, don't do it right out of the gate. So by not answering your question at all, after that, the real question is, okay, now I go out and I can't get a bank loan that I need, or I can't get other financing. I've tapped all of my other resources and I have a beautiful business and a beautiful plan and I need some money. Is that a fair statement, John?
Yeah, absolutely.
So then you say, okay, well, I would like to issue securities. I was excited about kind of a discussion. This is going to turn into a lecture, so I apologize. But, securities is a highly regulated space legally. And the reason for that is that the government knows the public needs protection from certain activities. And securities are one of those because they carry an inherent risk with them. So you have to understand, well, what is a security when I say it? And I take the term for granted because I throw it around every day when I'm speaking to clients, but it's not necessarily intuitive. Generally speaking, securities are investments in your company. The obvious ones are shares. John, if you and I started up a company and we each had 100 shares, we're 50% each. We go to raise money by selling new shares to someone else. We give someone another 50. Now we're 33 and a third, and there's a total pool of, I don't know if I did my math right there, but of 150. So like that's a security. Everyone knows that's a security. Borrowing can also be a security. And so you do have to be a little bit careful. Borrowing from a financial institution or a lender is typically not considered a security. But sometimes what people will do is put together promissory notes where they say, look, I'm going to borrow $100,000 from my friend over here, and they're going to share in the success of the business because of the way we've structured this and the coupon rate of that promissory note. The reason I bring that very boring topic up is because the minute you make the decision to start issuing those types of financial instruments out to somebody, now you're dealing in securities and you've hit this very regulated space.
So I've put sweat equity in. We've got a business plan that we think is going to work. We've looked for government grants. This next level, I'm immediately going to family and friends to say, where, I've got this thing, I think it's good. And, would you be open to investing in it in some form or lending you money?
The natural progression, right? And that brings us back to where we really started the dialogue around prospectus or prospectus exempt. If you're that new company and you're going to your family and friends, are you going to go and hire some lawyers and accountants and investment bankers to put together a $1 million IPO so that you can bring some money in? Probably not. You're probably just looking to bring in a few $100,000 to get you over the next hurdle. A lot of people call that your pre-seed money or your seed capital, right? Getting it going. So you go out to your friends and family. There is an exemption for that. You are allowed to sell investments of your company to your close friends, your family, and even your close business associates. So that allows you to go and do that. It has a certain finite element to it, right? Friends and family have been jokingly described as having to meet a bathroom test. And John, you may like this, but one of the things that even I've heard regulators joke about, how do you know if it's your friend or not? And the question is, well, you go in and you ask them and say, if you went to John's house and you had to use the bathroom, could you find it without asking him where it is? And that's your close friend, right? And if they don't meet that test, they're not a close friend. Some people can get themselves into trouble, especially some very successful entrepreneurs. And I've met them before. They seem like they're friends with the entire city. That definition of friendship is not necessarily the same definition that a securities regulator will use. They want that close relationship. And the purpose behind that is they want you distributing securities to somebody who has such an intimate relationship with you that theoretically they could obtain all of the information that would have otherwise been in the prospectus. Like, John, if you offered me up an investment and I were to sit down and say, okay, well, that sounds great, John. What are the barriers that you're encountering? Our relationship is such that I know you would give me a very straightforward answer. You wouldn't sell me, you would answer. That's who the friends and family and close business associates are supposed to be.
And would it be the most abused of the exclusions?
I don't want to, I don't want to pass judgment on that. The Alberta Securities Commission actually did a study on friends and family quite recently, and I think the findings were quite positive. That for the most part, this was being done very well, and so a credit to our industry at large. I think everybody goes into this wanting to do the right thing. I think it's one that maybe is more mistakenly breached. People don't do it right by accident. They just don't realize what it's supposed to achieve. But no, it is It's misused, but not as much as you would think. People are good for the most part.
One of the things that I've seen is I choose to invest in your company as a friend,
Yep.
and but one of the ways that I can justify my decision is by telling my friends and getting them to invest in it too, because then if they do as well, it kind of confirms my decision. So now
Yeah.
I've gone outside of the family and friends and gone one generation past. Does that make any
Yeah.
sense?
I know what you mean. And actually that's where you would get yourself into difficulty. There is no friend of a friend exemption. This isn't the however many degrees of Kevin Bacon that people talk about. You have to have that relationship directly between a director and officer of the company and the ultimate investor. When you start going beyond that, and that's where you need other exemptions. And don't worry, they exist. There are other ways to go and find different investors without going that full IPO prospectus route. But you have to meet different tests. Which is sort of a transition into what most people would view as the accredited investor, high net worth investors. And in fact, maybe more topical these days is to get out of the technical terms and say angel investors. How do you find the angel investors?
Yeah, and it's becoming more common in the tech space, particularly, right?
Well, and I think, part of this, John, is that the world is changing. I mean, we're all really aware of it. And sometimes it's a bit of a tired old adage that we say it so much, but things are very different. I mean, when a lot of these rules were originally created, I think it was quite reasonable for somebody to go out and raise enough money to put the down payment in on the equipment that they were buying, finance the rest from the bank, get their business up and running. That worked. The environment that we're in, unfortunately, just doesn't work that way anymore. Technical advancement is extremely expensive. People doing heavy R&D, that costs a lot of money. You can't just go out and raise a couple $100,000 and say, "Ooh, I'm going to go and invent, a new system to grow food out of a petri dish." It just doesn't work that way. So they need a lot more money than they needed in the past. And same thing with a lot of other technical companies where marketing is so fundamental because you need market share, and you can't accomplish an effective marketing strategy with pennies. It just is expensive now. So they need more money. Friends and family is insufficient. And that's why we've got a lot of wonderful companies in Alberta that are stagnating, because they go to the bank, they go to their friends and family, they've got a wonderful vision, but they can't execute because they're hitting that barrier of capital.
Yeah.
The angel world is coming in, and it's fantastic. Like it's really exciting to see. There's groups in Alberta like Startup TNT. I think you guys spoke to them once before, right?
We'll talk about a bit more about that.
Okay, and groups like that, and they're putting this whole ecosystem together, and it's amazing because they're bridging that gap where the IPO world is steadily climbing up, but the friends and family is kind of staying stagnant, and you've got this huge middle ground where you can't capital raise, and if you can't capital raise, your business might fail. Angel investors do that. There isn't something called an angel investor exemption. I can't just strap a set of wings to my back and go around telling companies that I'm allowed to buy their shares. It doesn't work that way. What those guys actually are accredited investors. They're typically people that are high net worth. We're talking like $1 million of financial assets, or incomes of $200,000 or $300,000 together as a family unit, that sort of thing, who the regulators have sort of assumed have the financial wherewithal and sophistication to both accept and bear risk. So they understand it and they can deal with the outcome if it doesn't work. Because we're not doing anybody a service here if we don't acknowledge private investments are risky.
Just by the very nature of a business startup, it has two directions, right?
Yeah, and that's, you can chase the outsized returns, but you have to know if you're pursuing outsized returns and the possibility to, buy Tesla before it goes public, or buy Uber before it goes public. That's great, but they're not all Teslas and Ubers. It doesn't always work out. So the downside is a lot more loss, and that's why it's a unique space.
I think back to March of 2020, we had this little thing called COVID come along, and all of a sudden we had shutdowns or certainly restrictions, and you could see that businesses that were living on cash flow very quickly were in trouble, and that's why the government was moving very quickly for some of the support programs, whether there was CERB or CUES or some of these support programs, because there was a lack of liquidity in a very short period of time.
Yeah.
And so that would be evidence of, think of a poor business that started in January or February with a, big 2020 plan. And all of a sudden they had family and friends money spent and couldn't drive revenue. They were, a restaurant, a hotel, one of those many areas that got shut down by COVID. So, liquidity becomes such a important characteristic of this discussion.
Yeah, liquidity is key. And I mean, I would never try to say that what happened with the COVID pandemic was a good thing, but what it showed to me was how innovative and resilient a lot of our entrepreneurial community can be. And it really cemented home what we were talking about earlier on, which is you don't start with loans and raising money through selling investments. You start with bootstrapping, working your tail off, and you start by, finding government grants or the support that is there. If it's there, I'm not saying whether those are good policy or not, but you go for everything that you can before you have to start adding risk to your own plate, because you're already taking risk by running your business. And I, anecdotally was very pleased to watch how people did that. And quite frankly, I was dumbfounded how many businesses managed to weather that storm as well as they did. They worked their tails off. What we owe them now is the path out, right? Those that did it. Now, just because you kept the lights on doesn't mean that you kept your business thriving. And in order to bring it back, to give it the little jolt of electricity, that's where that capital comes in. And that's when you start going, okay, now we can raise money with investors. We can show people that I, as an entrepreneur, was able to get through one of the toughest times that we've seen in recent memory. That alone is a feather in my cap. And I'll go to the investors and I'll show them how I did that. They'll trust me now. They'll write that check. I'll give them some shares, and we're going to knock this thing out of the park in the next, 2, 3, 5, 10 years.
I think of the Calgary floods. When you have a property that survived a 1 in 100-year flood, it's pretty safe for the next 100 years. Not guaranteed, but certainly has a higher likelihood of not getting flooded. So
we certainly hope so. Yeah. So those galvanizing events are good. But to bring it back, John, I mean, so then this is the, I've got my friends and family money, and now I'm going out. It's the angel investors that I'm looking for. And you go to accredited investors. And that works. It exists. The nice thing about angel investors is they often run in circles like the startup TNT world, where they're familiar with these exemptions. And it's a very interesting dichotomy where a lot of times issuers kind of come in and they say, hey, I'm looking to raise money. And the investor's telling them, well, here's how you have to do it. They're building term sheets and they're saying, here's the exemptions, here's who's allowed to. But if you do go into those clubs and those groups, there is a certain type of issuer. And when I say issuer, I mean, business, startup companies and businesses. There's a certain type of business that you find there, and they are very tech heavy, innovation heavy, and high growth. A lot of them do view the initial public offering, the IPO, as the end horizon. That's where they're going to go. They're just not there yet. This is another thing, though, that I think we sometimes are doing the entrepreneurial community a disservice, because for every, Uber or whatever other kind of high tech company that is getting out there, there's still a lot of those, roots based companies that need to exist. There is your corner store. There's your local restaurant. There's, the manufacturing shop down the street. For the most part, angel investors aren't going into that space. And we are seeing that they're very underserved. And I think, a credit to the Alberta Securities Commission, who created the New Economy division. I think they're recognizing that group needs support too, because they were kind of the quiet left behind group. As the cost of raising money got higher up and the barriers to raising money from close circles and accredited investors, that, there's less money available and there's more barriers. They just kind of sat back and were stuck. No one was helping them. And that's where, if I can, I would almost shift to some really neat things that the Alberta Securities Commission is doing that really drives home the fact that they're not the villains in the story. They're working as best they can to protect as many stakeholders as they can, just like we are.
Protect and kind of encourage innovation. They're not just on the defensive side, right?
Yeah, I mean, just the name of it, like it's the New Economy division. Like their goal is out there to look at the way the economy is changing and make sure that the securities regime is out there to support. It's not true to say that securities regulators don't want securities being distributed, that they don't want small businesses to raise capital. What they want to do is make sure that they can do that as efficiently and effectively as possible without causing undue risk and harm to, ma and pa investor. And
so let's talk about this whole, is it 2 or 3 new things that have come out?
It's always tough to nail down just how many there are, because they're kind of coming constantly. And a lot of times it also involves going back and looking at previous regulation and just massaging it a little bit, changing the way that it works. But the ones that have come out recently within the last 12 months that I think should be interesting to everybody who is looking to raise money are crowdfunding, which we'll talk about a little bit and kind of break down how that actually works. Something called the self-certified investor, which expands what an accredited investor looks like. And then a proposed one right now is called the small business financing exemption. Now, those are the 3 I'd want to talk about. Crowdfunding is national, so that would apply right across Canada, and kind of has to by the nature of crowdfunding. It's an online exercise. You can't really say, put a website up and then barrier it so only people in Alberta can go. The other 2, though, the self-certified investors and the small business financing, are initiatives that have come primarily out of Alberta and Saskatchewan. And so they're the only ones that have adopted or thinking about adopting these.
So let's talk about how much do you want to spend on crowdfunding?
Maybe we can circle back. I'll sort of preface that by saying, I personally think crowdfunding has the potential to be a very interesting space. But for a few exceptions out there, Front Funder, I think, being one of them, it is not particularly successful right now in picking up market share because of some regulatory headwinds, as well as some just, technology headwinds. There's not a lot of easy crowdfunding platforms out there, so it's hard to use. It's something that I would encourage kind of the serial entrepreneurs to keep an eye on. But if you were calling me today to say I need to raise some money, I wouldn't say that crowdfunding is a viable option. It will be one day, I hope.
You hear it a lot, and more sensational than kind of ordinary, if that makes sense.
Yeah, and just in case anybody is in the background going, but wait a minute, crowdfunding's been around for a long time. It's been around for a little while in the States, but what most people call crowdfunding isn't really crowdfunding from a security standpoint. It was basically glorified pre-sales. So a lot of times what people were doing before was, I wanted to raise some money because I've designed the world's coolest backpack. I would just go out to the market and say, like, here's the design for my backpack. And anybody who gives me $50 will get one of these things the minute I'm done. And also a really cool sticker and my mixtape or something like that, right? Like, they throw it together. That was crowdfunding, but no one owned the company. What the regulators have opened up with this new national instrument is that I don't have to sell people the backpack and my mixtape. I can say, here is a share of my company that you buy, and you will then benefit from the profits it derives if I'm successful.
Quite a difference.
Markedly different, and yet we're using the same word, which confuses people to no end. The other 2, though, so self-certified and small business, and I think self-certified is a great one to start because that one exists right now. That is active. It is allowed in Alberta.
So I'm very curious. I was on the securities website trying to better understand it, but please explain what this thing is.
Yeah, so self-certified investor. Now, in order to understand this, I kind of have to go backwards again. And the term we used earlier, accredited investor. And I likened that to the angel investors. Most angel investors are accredited investors. That's how they get to play in this space. That definition has been around for a while, and it, in its existing form or similar, really exists in most jurisdictions out there. So there's accredited investors in the US, just like there is in Canada. But it has been steeped in what I think is an antiquated notion that is, if you're rich, you're smart. And I kind of loathe that, right? Like, they say that if you make $200,000 a year or $300,000 a year together as a family unit, that you must therefore be smart enough to evaluate investments without disclosure and make decisions. It also says, I've got $1 million of financial assets. I'm so rich, I must be brilliant. $5 million of total assets, like real estate, things like that. I'm so rich, I know how to do this. I think that I want to give the ASC a lot of credit, and Saskatchewan as well, that when they did this self-certified exemption, they realized that that wasn't the be all and end all. We are not ordained by the dollar and suddenly gifted with this level of sophistication to invest in private enterprise. Money may not actually be the only factor. And so what they've done is they said, okay, well, what if you could self-certify yourself to invest in this space? Self-certified on the basis typically of knowledge and information that you have. And so they've opened it up to a lot of people that would already exist in the finance professional space, CPAs and CFAs, certain lawyers, people with their MBA, finance graduates. And one that's really interesting is you can even go and take a class, the Canadian Securities course. And if you've taken it within a certain time frame, that you're deemed to be sophisticated enough to make these investment decisions by yourself. There are some real drawbacks to this exemption as it exists right now. And firstly, it's that is still a very small pool to draw from and continues to introduce a level of privilege that is difficult for certain investors. With just the accredited, or certain issuers, I should say, with accredited investors, if I was a business person, I've got a great idea. I could probably go and raise the money I need if I was raised at the country club and I know everybody who has all the money in the world and could be angel investors under the traditional sense. So there's a privilege that I have then as an entrepreneur to go and raise that capital. That's growing now when we say it's not just money, but there's still going to be, it's a privilege of, do you run in the circles of financial professionals? So, if I'm working with a lot of CPAs and CFAs and lawyers, sure, I might be able to raise money from them. But if I'm not, there's still a bit of a barrier. But we're going in the right direction. And I cannot applaud the ASC in Saskatchewan enough for the fact that they are finally stepping back and saying, there are other factors we need to consider, because what they're doing is exposing the public to risk. So under what fact scenarios is that risk appropriate? Money may have been one of them, but now we're also realizing that sophistication and the ability to make your own decisions is another one. And who knows where we go from there. But it's such a seismic philosophical shift to start recognizing that, as I said, you're not just ordained by the dollar. There are other mechanisms to access this space. That's the only way that will ultimately democratize that private investment world.
It's Phil, I was talking to a business owner the other day who sold his business for $10 million. And he said, I had a business that I knew how to run, and I just traded it in for this stuff called money. And he said, I know nothing about this stuff called money. All I knew was how to run my business and earn it. Now I have to figure out what to do with this stuff. And he said, I'm more scared. I'd rather just run my business than have this $10 million. And so I think, to your point, having money is one thing. Knowing what to do with it is quite another.
Yeah.
So I'm intrigued by that self-certified.
Yeah, it's great. And again, like if you can find those people, and if anyone is very curious, it's blanket order 35538. I mean, you can see who they are. You can find this stuff at the Alberta Securities Commission website. It's not that difficult to navigate. Quite frankly, you can even call the Alberta Securities Commission. They're quite fantastic. They'll help you find these things. They've got some good resources. But the problem is that it's not far enough to solve the problem. If the problem is that there are these kind of non-tech startup companies that need capital, the traditional angel space isn't there. Finance professionals probably aren't the next place that they're going to look either. It's just, we've moved a little bit, but it's more a celebration of the fact that we're moving than the fact that we've solved it.
Have they acknowledged that they haven't moved far enough?
Far be it from me to speak for the regulator. I think what they acknowledge is that just as it's important for industry to be constantly innovating, it's important for our regulators to be constantly innovating. And I think that's a huge acknowledgement from a group that, may have historically been looked down upon as being too stagnant, too bureaucratic. And I think it speaks very well for what Alberta will be able to do in the long term if we have our government and pseudo-government agencies carrying that same entrepreneurial spirit that our business community has. I think that synergy is huge. They have said that they need to consider this, but they're also very cautious in that you have to walk before you run. They've looked at this group of, sort of the finance professionals is what I'm calling them, and saying, okay, we can probably allow these people to go and make investment decisions without all that transparency that you find in a public security. What's next? Well, I hope there's more. But the last thing the regulators want to do is say, okay, it can be anybody. Let's see what happens here. because as much as we say from the business community to be like, these guys aren't letting me raise money, and that frustrates me, trust that they get just as many phone calls from investors that say, I lost my money. How could this have happened to me? So they're constantly balancing two things as well.
Yeah, it is an interesting one to try to find that spot in between. But it's music to Alberta enterprise ears when we hear you talking about getting the alignment of a government agency and the business community, because everybody's in it for the same reasons, right? How do you create prosperity in the province, right? When we create a business that's successful, it hires these things called people, and those people end up paying taxes, and that taxes is the one who pays for all this stuff that the government's doing. So the whole machine works properly if we get alignment. It's absolutely thrilling to hear you talking about agencies, and maybe this is the red tape reduction that we've been trying to get through in Alberta.
It's something that comes up commonly in the dialogues, that red tape reduction is extremely important. Now, I mean, I'm not trying to tell everybody that this is, buttercups and butterflies out there. Like, the regulators, quite frankly, they bias towards investor protection, and they're extremely cautious as they move. I mean, there's a reason that we're doing the self-certified thing, and accredited investors have been around for, well north of 25 years, I believe now. So like, this is a slow moving glacier to go in the right direction, but it is starting to move faster. And I love that the fact the team over there is happy to have conversations and work through it, which does lead to sort of the next proposed exemption that they have. The self-certified one are still talking about a very finite circle of people. And they have proposed a new one called a small business financing exemption. Now, this isn't out there, and the comment period on it has closed. But if you like what I'm about to tell you as a business community, let the regulators know, because they're happy to hear your feedback. Small business financing allows you to use a very small disclosure document. You don't need to have IFRS audited financial statements and all of the complexity that comes with that. And you can raise a small amount of money from anybody in small increments. It's kind of like crowdfunding without the online portal and the need to put your financial information into a computer, which, quite frankly, is one of my concerns. When I said crowdfunding isn't going to work, there's a technology barrier, but there's also a psychological barrier. There are a lot of people still today that aren't comfortable sending money online through the computer. They like to have the check. They like to talk to the bank teller, and that is completely fair, whatever people are comfortable with. What I didn't like is that we had securities rules that weren't technology agnostic. We're suddenly biasing and saying, okay, we're going to favor people that are on their computer, and that wasn't right. And credit to the Securities Commission, they said, okay, it was small business. So now we've got disclosure, small amounts of money, anybody can come and play in the space. This one hasn't been approved, but I think that is another huge step forward to start saying to the public at large that perhaps we were even wrong in saying that you're ordained by the dollar, that money was sophistication, and maybe even saying, maybe, knowledge isn't just the only thing that is sophisticated. Maybe we can just put some limits and say, play responsibly. I mean, it's basically like the same warning you would get now if you walk into the casino, like, play what you can afford to lose. And if they regulate that way, we might be able to nurture people up through the system in a way that they're learning to play responsibly. And supporting local businesses, supporting private investments is very important, but it is risky. You have to do it intelligently. And teaching people how to get there is key. And that might be a transition into groups like, the angel groups out there.
Yeah. Again, you can see the steps forming. Small business. So what would be the limits? Sorry, on.
Yeah, this is a great question. So it's you can raise up to $1.5 million without having any financial information included. And then I believe, and I'm sorry, I should have this written down, but I believe it's $5 million with it's basically like gap-based financials instead of IFRS, which to most people won't make sense. But if you go and talk to your accountant, they'll tell you how much better that is. It's cheaper to consolidate the information, and what you have to put out on an ongoing basis is different. So then you get that financial information. Individuals can put in $2,500 into an investment, which frankly doesn't really move the needle. But for those that meet a much lower financial threshold personally, so like $75,000 a year in income, they can actually go up to $10,000. So this is a way to open the door to everybody else. And for anyone who might know the space intimately, you'll say, ooh, like $10,000 sounds like we're talking about the offering memorandum. I didn't talk about that one at all because it's just relatively complex, but it's very similar principles now being applied downstream.
Well, but it is important to talk a little bit about that, Phil. That there's this accredited investor, which is has got some bars defined, and somebody who has accumulated some money but doesn't have as high an income wants to get into this space. Let's just talk a little bit about that group, because I think sometimes people go, who are you to tell me I can't invest in this marketplace? If I'm willing to take the risk, why can't I, right?
Yeah, I mean, I'd be lying if I said I don't agree with that more often than not. I try to take a more pragmatic approach and at least understand the other position, but I do sort of have that attitude of, do what you want. If you're not hurting anyone other than yourself, to quote someone we both know, fill your boots. But there are other avenues towards that. And offering memorandum being one of them. Sorry, I'm going to go off on a diatribe. I wasn't planning to talk about this, but you raised something that is a bit of a hot button topic, investor autonomy. Why am I not allowed to do what I want to do? Regulators have an investor protection mandate, a public protection job. And while you might say that some people should be able to make those decisions, the game changes a little bit when you've got somebody telling you, hey, invest in this, do that, it's a great deal, you'll never lose. Like, the process is not one directional or unidirectional. It's, it's a sale to it as well. And that salesperson can add a lot of danger unless they act responsibly. However, what I think we're seeing right now that is very fascinating to me is allegations that some of those quote unquote, public mandates of investor protection are actually being abused by those in power. And that came up a little bit with the fascinating GameStop saga that we just went through, right? Like, we had a whole bunch of people investing wildly in something and inflating its value. I'm not saying inflating incorrectly. I'm not going to pass judgment on whether or not those values were correct, but they drove up the price of something, putting in money. And, I read the forums. I'm going to take out a student loan and do that. It was everything that the regulators say that they don't want to have happen, because if it went bad, those people would be crushed. Now, for many of them, it didn't go bad and they did well. And then some of the brokerages came in and said, in order for me to be comfortable with my compliance and my regulation, I'm shutting it down, which actually caused the share price to fall down. And everybody said, you didn't do that to protect me. You did that to help somebody else. And it goes to show how complicated the world is. You try to protect somebody and another guy weaponizes that and finds a way to hurt somebody with it. And so all I learned throughout that entire thing was not how to game the market or do anything more successful. What I learned was to be a lot more sympathetic to just how tough this job is for both the businesses and the regulators, and why we have to have the discussions about it. Let's find the right way. The last thing we can ever be is closed-minded about it. The regulators can't be closed-minded. They have to have these discussions, and business can't be closed-minded. They have to understand that there are investor protection mandates that are worthy of discussion. Let's just find the right spot together.
It's a very interesting discussion, Phil. I know we could go quite long on this, because just by the very nature of an entrepreneur, they've got a risk profile which is different to the average. I was going to say the normal person. There's something magical about entrepreneurs, and they have this. They don't see risk the same way that other people do, and it's what makes them so special.
Well, you're right. And the worst thing we could do is inadvertently outlaw risk taking. I was I don't know if it's still on the tower, because it's been a long time since I spent any time downtown, but there is a tower in Edmonton that says, I think it says, take a risk. It's the most Edmonton thing you can do.
Yeah.
And like, I love that. I don't think it's just an Edmonton thing. Like, it's, anywhere in Canada, Alberta, Calgary, certainly, all these places that's there. But we should never accidentally outlaw risk taking. Periods of significant risk have yielded very positive outcomes for certain economies. Tempered risk is wise for the individual. And so to balance those is what we need to do.
Yeah, it's I always tell the story. A buddy of mine plays Texas Hold'em poker on the Canadian tour. And we ran into a guy, and somebody said to him, hey, I hear you gamble. And he goes, no, I play poker. And they're like, yeah, no, that's what I meant. And he's like, well, those are two very different things. One of them is calculated risk, and one of them is a game of chance. And so, again, entrepreneurs calculate risk. They understand it, they see it differently, and they take it. It's what makes our Jack Mintz was talking about this. He was on a conference in April or May, and he said volatility is our greatest gift in Alberta, because we've learned to live the ups and learned to live the downs, whereas some other provinces don't have that cycle. It's a horrible cycle when you're on the bottom of it, but it teaches resilience. And so, again, we have to be so careful that we don't regulate risk completely out of the system, because risk and reward are so carefully managed.
Well, so, yeah. I mean, if all we had was guaranteed investments, we'd basically be dictating the inflation rate. I mean, that opens up another discussion I'd rather stay away from, but printing money may not always be the wisest decision. And so risk has to be introduced into the equation. There's nothing wrong with failure. It happens. We get back up. That's how it works.
Now, Phil, we got to watch our time a little bit. There's one of the things I wanted to ask you about is you and I spent some time together raising capital or working with an organization that was helping for people to invest. And I want to talk about kind of what I always refer to as the 4 M's of how a investor should evaluate an investment.
Okay.
So I say there's kind of 4 things: management, the business model, making sure the business model, that the investor wins first and the company wins second. Motivation, what is the driving motivation for the management? And then the market, is there a market for the particular business that they want to have? Do you want to talk at all about how that's properly explained, or am I taking you down a bad area?
No, it's great, but I mean, that level of thought is above my pay grade. It takes a certain finesse and expertise to evaluate investments, and I wouldn't ever lie to say that I'm a stock picker. I'm not. I've shown myself to not be very good at that sometimes. But what I think it does open up is that there are important considerations when you're making an investment decision. And now we're speaking from sort of the investor standpoint. I think primarily there is no harm in seeking of expertise. I mean, we talk about this ability to make your own risk decision, but now let's go full circle. There is always the opportunity to have somebody help you evaluate risk and make those decisions. And those are the registrants, the people that are in the business of dealing or advising, portfolio managers, IROC dealers, mutual fund dealers, exempt market dealers. They're out there, and they have a really fascinating obligation. There's 3 of them. One is KYC, know your client. One is KYP, know your product. And then that little linkage of suitability. Make sure that what I know about my client, the investor, and what I know about the investment I'm about to sell them is right based on what they're trying to accomplish here. And I don't know, John, am I allowed to throw a plug into this at all? And
please.
I mean, there is a group locally here in Edmonton. There's a bunch in Alberta actually, but like Raintree Financial Solutions is an exempt market dealer. So if someone's interested in exempt market securities, that's a great group to talk to. And because I'm equal opportunity, I mean, there's also Pinnacle down in Calgary is their head office. Both, I think, have advisors all over the place. But as a whole, the exempt market is a good place to go and talk to somebody if you like getting into the private capital space and you're not all the way sophisticated. The next plug is that if you're sort of in that angel space, there are groups that can help coach you along that pathway as well. And I mentioned them earlier, but Startup TNT is doing some fantastic things. And you'll see very different investment types depending on who you talk to. So
a couple minutes here, Phil. Raintree is a member of Alberta Enterprise Group, so I don't mind a plug.
Well, I like them.
Let's talk about Startup TNT, because it's a term people are hearing a lot about, and they don't fully understand. They are a client of yours or a relationship?
I won't comment on anyone who is or is not a client. Sorry, John. They are a relationship. Now, what I will say is I actually participated in one of their summits. It was amazing. I was dumbfounded by just how fantastic it was.
So what is this summit thing? What is Startup TNT?
Yeah, so Startup TNT, they're unlike anything I'd ever run into before. There are sort of angel investor networks and angel investment clubs that get together and they all pick investments and they talk about them. But Startup TNT is an entrepreneurship and angel community is the best way to describe it. I mean, it's a very communal feel of getting people together and sharing information, not just about, pick this investment, it's going to win, or pick that one, but, they do practice pitches. They introduce advisory groups to each other. The summit that I participated in was one of their exercises that does result in capital being deployed to, a local business. And it was great. But, I've seen capital raised for a lot of years now. That's the space that I'm in. So, that doesn't knock my socks off to see a big check written to a company. What blew me away was that even the companies that didn't get big checks were getting advice from very successful past entrepreneurs all over the demographic spectrum in age and experience and otherwise. And oftentimes people were pinging, opportunities back to each other where, you look at a business, you're not looking to invest in it, but you say, hey, you're doing this. You really ought to talk to this person over here. And as much as angel investing is great, it's that pride in Alberta business that I love the most. We far too often pat each other on the back because we landed a deal in Toronto. I don't mean to speak ill of Toronto, but I don't understand why we aren't spending more time patting each other on the back because we landed a deal in Alberta. And there are amazing companies in our own backyard that we don't even look to for whatever reason. And it's this type of initiative that sort of focuses everybody back again. And I love it.
So the pitch that they did, you were involved with, raised $150,000 for the winner.
Yeah. So maybe it's raised $150,000 for a winner in Edmonton, $150,000 for a winner in Calgary, give or take. Those numbers aren't quite perfect, but as an outflow of that, the angel community, including some, guys that turned out to participate and were venture capitalists, that angel plus world. And the total amount of capital that was given to the companies that had participated ended up being far north of $1 million. And, those are the side deals that are struck and the term sheets that are negotiated. And it just goes to show that the magic happens not when you're just out raising money, but when you're building a community. And they found each other.
It's a fascinating link, and it's the way Alberta is going to move forward is when we take the genius of so much. We took this little thing called bitumen that was coming out the sides of a river and turned it into an industry that literally powered the world. We need to take that same ingenuity and couple the genius that have been running things and the geniuses that are coming, and that's what I think Startup TNT does. So very interesting, and I think it's going to be. So we're inviting many of our members, any of our members who want to join in, that are accredited investors, to come in and go into the next pitch, and we're having a meeting next Wednesday to explain the process.
Yeah, I think it's great, and what I would encourage everybody who does that is to not just focus on, am I here to buy an investment? Because I don't think that's what it's about. It's are you there to learn and get advice? And that would be my parting comment for everybody on the spectrum. Regulators too. We are at a time where sharing information and sharing knowledge is more convenient and more impactful than it ever has been before. If you're an entrepreneur and you want to raise money, you're not alone. There are groups out there that will help you do it. I mean, obviously that comes with a cost, just like your business charges for its services. But, go out there. There's corporate finance teams that will help you strategize. There's dealers that will help you raise money. There's all sorts of things. If you're an angel investor or you want to become an angel investor, there's groups out there that will help you learn how to do that safely and more responsibly. I shouldn't say safe, it's always risky, but more responsibly. And for regulators, dialogue with those people, find out what they are trying to accomplish and what their barriers are. And, it's that sharing of information is key. It's how we get to the end.
Listen, we got to end this. You've got another meeting to get to. Thank you, Phil, for taking your time and sharing this. You have a combination of an expertise and an ability to explain it in the terms that people like John Liston can understand it.
Well, I don't know if I understand it when I explain it sometimes. So I appreciate being so patient, and I'm sorry that it got a bit more detailed maybe than it needed to be at times, but it was a lot of fun. Thanks, John.
Exactly what we wanted. So listen, everybody, these are the kind of people that are around, and we continue to try to find experts to put in front of all of you. The Alberta Enterprise Group is just trying to create Alberta prosperity. And again, understanding capital raising, I think, is a vital characteristic to it. So, Phil, thanks for taking the time. Thank you, everybody, for listening in, and stay tuned for next week's events.
Thanks, John.